1998. Long-term capital management. Long-term capital management was a very non-conspicuous name for the biggest hedge fund during the 1990s. A hedge fund that single-handedly almost collapsed the entire financial system. Yet another world-changing event that has slipped under the public's consciousness.
The whole economic system was going to collapse if the bailout didn't happen.
They got some very high returns during their first few years, 21%, 43%, then 41% in their third year. For reference, the stock market typically returns 7 to 10% on average, so their returns understandably attracted a lot of attention and money. And before long, every bank and even universities got greedy and wanted to lend LTCM as much money as they could, so LTCM could grow it for them. And by 1998, LTCM raised $4.7 billion from practically every single important financial institution. They took that $4.7 billion and borrowed $125 billion to play around with. A 25-to-1 debt-to-equity ratio. So imagine whatever money you have in your bank account right now, borrow 25 times that in debt, and use that money to do super complex trades based on brand new mathematical models that probably no one double-checked or fully understood besides the math experts that made them. But they didn't stop there, no. LTCM took that $125 billion in debt and turned it into $1.25 trillion. 100x on the money they already borrowed.
These guys in a room took $4.8 billion, got Knucklehead over here to give them $125, and then got these knuckleheads to sell them positions, and all of a sudden, $4.8 billion equaled $1.4 trillion.
And since all the major financial players had a ton of money tied up in LTCM, if LTCM went down, they would go down too. Or in other words, this single hedge fund became so big that it was too big to fail. And their time of reckoning came in mid-1998. Multiple factors like the 1997 Asian financial crisis and the 1998 Russian financial crisis all crescendoed together into the perfect storm. Their mathematical models broke down, and because they were so leveraged, $4.7 billion to $125 billion to $1.25 trillion, their losses got insanely amplified. And by September 1998, LTCM was out of options. And since everyone's money was tied into this one hedge fund, everyone on Wall Street thought that if they fell, the entire system would collapse. We can't let that happen. So the Federal Reserve Bank of New York stepped in and coordinated, what do you know, a bailout. A bailout of $3.6 billion from other major banks. Chase, Deutsche, Goldman Sachs, Merrill Lynch, Lehman Brothers, practically all the major players. Steve Cohen, Point72, Forbes 400 rank, number 36. Net worth, $14.5 billion. 2019 net worth, $13.6 billion, up almost $1 billion. Steve Cohen runs Point72 Asset Management, the 21st largest hedge fund in the world. He's the owner of the New York Mets, owns one of the world's most valuable art collections worth over $1 billion, and in 2007, Time magazine named him one of the top 100 most influential people. And his name may sound familiar after the whole Gamestop mania. Cohen's fund lost nearly 15% this year during the Gamestop Short Squeeze because his fund invests in Melvin Capital, one of the main hedge funds that was shorting GameStop. Cohen was also one of the two hedge funds that bailed out Melvin Capital with $750 million when they were on the brink of collapse. This led to him getting death threats on Twitter, which made him delete his account. If you want to learn more about the GameStop Short Squeeze, we have the most detailed documentary on it with the link below. What you may not know is that Steve Cohen walked away from one of the biggest insider trading scandals on Wall Street. In 2013, his original hedge fund, S.A.C Capital Advisors, pled guilty to insider trading, wire fraud, 4 counts of security fraud, and paid $1.8 billion in fines, the biggest fine ever levied against a hedge fund. Cohen was banned from managing outside money for 2 years, and after that ban was lifted, that's when he started his current fund, Point72. This whole scandal was one of the big inspirations for season 1 of the show Billions.
I employ hundreds of people directly, thousands indirectly. What do you do? Nothing.
Gabriel Plotkin, Melvin Capital. During the fallout of Steve Cohen's first hedge fund, S.A.C Capital, Gabriel Plotkin was one of the traders who received the illegal insider information according to federal prosecutors. After S.A.C Capital pled guilty to insider trading and closed shop, Gabriel Plotkin would go on to create Melvin Capital, raising $1 billion with a focus on short selling. Although not a billionaire according to some estimates, Melvin Capital is still worth covering. In Melvin Capital's first year, they returned an incredible 47%. In 2020, Melvin Capital shorted game developer CD Projekt, making millions when Cyberpunk 2077 flopped. And after the GameStop short squeeze, Melvin Capital was down 53%. Ken Griffin, Citadel, Forbes 400 rank, number 34, net worth, $15 billion, 2019 net worth, $12.7 billion, up over $2 billion. Ken Griffin founded Citadel, an American multinational hedge fund with two main businesses. Citadel, the world's 9th largest hedge fund with over $34 billion under management, and Citadel Securities, which is what's called a market maker. When you buy or sell a stock on an app like Robinhood, firms like Citadel Securities are the ones that actually fulfill the order for you. In fact, Citadel executes 1 out of every 3 stock orders from retail investors. So if you've bought or sold stocks in the past, chances are you dealt with Citadel without even realizing it. Citadel Securities is also one of the firms Robinhood sells your trading data to, also known as payment for order flow. During the first half of 2020 alone, they doubled their profits to $4 billion in revenue thanks to increased trading and volatility. Again, to learn more about how this business works, check out our documentary on the Gamestop Short Squeeze below. Needless to say, this makes Ken Griffin a very powerful billionaire in the world of high finance. Ken Griffin was the other hedge fund to bail out Melvin Capital with $2 billion alongside Steve Cohen. Chase Coleman, Forbes 400 rank, number 85, net worth, $6.9 billion, 2019 net worth, $4.5 billion, up nearly $2.5 billion. When you imagine a young, hyper-successful shark of an American hedge fund billionaire, that's Chase Coleman. Charles Payson Coleman III was born into New York aristocracy and trained under a legendary hedge fund billionaire, Julian Robertson. At 25, his mentor handed him $25 million to start his own fund, Tiger Global Management. His fund has seen insane returns over the years, and in 2020, while the real world was descending into chaos, Chase led the hedge fund billionaire pack by gaining $2.5 to $3 billion in net worth. One can't talk about hedge fund billionaires without mentioning perhaps the most infamous one, George Soros. Forbes 400 rank, number 56, net worth, $8.6 billion, 2019 net worth, also $8.6 billion. Before all the controversy and conspiracy theories surrounding Soros today, Soros became known as the man who broke the Bank of England and made $1 billion in the process. In the early 90s, Britain was in the middle of a recession and the British pound was continuously weakening over time. And every currency speculator and forex trader knew that eventually, the pound would have to devalue soon. And if one could know when that happens, or if one could make that happen, one could short the British pound before it goes down, making billions. So in 1992, Soros started building his position against the British pound by borrowing pounds from British banks and hedge funds. Basically, he was taking out loans. And then he started selling those pounds that he borrowed for German marks, so that when the pound crashes, he could buy back more pounds than what he sold for. Therefore, the lower the pound crashes, the higher his profit margin on money that wasn't even his. Pretty clever. On September 16th, Soros exploited a vague statement made by the president of the German central bank to make it seem like the German central bank thought the British pound was in trouble. Kinda like how the media takes things out of context today. That night, Soros sold 10 billion pounds he borrowed on the open market. By morning, that started a selling panic that the Bank of England couldn't control. By the next day, the pound fell by 15% against the German mark and 25% against the dollar, making Soros $1 billion in a matter of a few days, at the expense of $15 per person in the UK, which is the perfect segue into the strategies you want to use as a hedge fund billionaire.
These are the apex predators of Wall Street. They are in the business of shorting companies to destroy them. I mean, that is their business model. And they are not academic traders, okay, who are just speculating on outcome. They engineer the outcome, right? Look at their tactics. Just watch the show Billions, right? They hire PR people. They hire private investigators. They're participating on these message boards, spreading disinformation. They try to destroy companies to engineer that outcome. They create nothing. They are in the business of destruction.
Now you may be asking yourself, but Jake, not all hedge funds are bad, right? Yes, 100%. It's a spectrum. There are big hedge funds, small funds, hedge funds that are extremely boring, quantitative hedge funds that rely on math and computer algorithms, hedge funds that focus on shorting for what they believe to be the greater good of the market, everything under the sun. Ray Dalio is a billionaire that founded the biggest hedge fund, Bridgewater Associates, that I have a lot of respect for. But let's be honest, you didn't come to this video to learn about all the legal things, the morally white things hedge funds do. No, you came to learn about the shadier, morally gray stuff some of them or many of them pull off, which usually involves short selling. So if you want to learn how to be one of these billionaire hedge fund apex predators, let's set our ideas of right and wrong aside just for a few minutes to learn the secrets of the trade. Soros's shorting of the British pound perfectly encapsulates your duty as a hedge fund manager. Your job is to not just predict where a stock, a currency, or any other security is going to go and just hopes that it goes there. That is for chumps. No, your goal is to spot opportunities in the market and then engineer that outcome to happen. Because let's be honest, in this world, the only person you can rely on is yourself and your actions. So make the outcome you want happen. Remember, at the end of the day, the stock market, the currency markets, whatever market you're trying to manipulate is made up of people. No matter how complex a market gets, no matter how many computer algorithms they use, no matter if they have CDOs, CDO squares, synthetic CDOs, it all comes down to human nature, fear, and greed. And that's what all of our strategies boil down to, triggering people's greed to create a buying mob, or triggering people's fear to create a selling mob. If you've ever been to a seminar where they try to sell you expensive stuff, they always put the table to buy in the back of the room. Why? So that when people buy, the people sitting down see all those people getting up and walking to the back, which makes them want to get up and buy, which creates what marketers call a table rush of buyers. That is the exact herd mentality we have to create in the markets. And that's why the best hedge funds, the best outcome engineers, are really just the ones that understand human psychology the best and apply it to stocks or whatever.
There's a small group who can do the math. There's an even smaller group who can explain it. But those few who can do both, they become billionaires.
You know Jim Cramer? That kind of annoying guy always screaming about stocks on TV?
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica.
What you may not know is that he used to be a hedge fund manager that was an expert at all these dirty tactics, especially with short selling. And in December 2006, when the internet was still young, Jim did an interview that he thought wouldn't be seen by the general public where he reviewed all his secrets.
What's important when you're in that hedge fund mode is to not do anything remotely truthful. Because the truth is so against your view that it's important to create a new truth to develop a fiction.
Front running the markets. Let's say it's close to the end of the quarter, you're not hitting your numbers, and you gotta show that your hedge fund is in the green or else investors will withdraw their money, and you won't get that big of a management fee.
Now, I gotta go into New York to try and save my fucking quarter.
You're long a stock, so you want to make a particular stock go up, so you do what's called front running the markets. You dump a ton of money into a stock during pre-market hours, i.e. before the stock market opens. People will see all this activity and growth in the stock before the market opens, and they'll think to themselves, man, maybe they're gonna make a big announcement, show off a new product that these stock traders know about. I gotta get in on this. So the herd would join you, the trading algorithms will get triggered, more of the herd joins you, and boom, the stock price soars and your quarter is saved. Back in Cramer's days, you need around $5 million to dump into a stock for good effect.
If I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher. And maybe commit $5 million in capital to do it, and I could affect it.
Today, that might be 15 million, 20 million, or maybe even more. Killing the markets. The opposite is also true. If you're shorting a stock, i.e. profiting if it goes down, you can create a negative stigma around a stock by selling a few million in the pre-market. And just like how Soros selling 10 million pounds the night before to create a selling panic that crashed the British pound, you dumping a bunch of shares of a stock during pre-market hours would then trigger the herd's fear. Why is my stock going down so much before the market even opens? What if it crashes even more when the market opens? Man, should I sell and cover my losses so I'm not a bag holder? And boom, when the market opens, a lot of people will sell, upping your profits.
But it's a fun game, and it's a lucrative game, and
Now, there's nothing really illegal about these tactics. They're pretty simple. You just need a lot of capital to make it happen.
I would encourage anyone who's in the hedge fund game to do it because it's legal. Right. It is a very quick way to make money and very satisfying. But by the way, no one else in the world would ever admit that, but I can care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
But beyond this, that's where we get into fomenting. Fomenting. Now, I'm definitely not advising you to foment. Fomenting, where you intentionally create the impression that a stock is going to go up or down, is in fact illegal. I can neither confirm nor deny that hedge funds definitely do this. But for educational purposes only,
Lawyer.
Let's go over how to create this fake impression around a stock if you choose to take this illegal route. That is very hard to prove in a court of law that I'm definitely not condoning.
You know exactly what I mean. You induced others to trade on information that you knew to be false. Hard to prove that.
you can't foment. You can't create yourself an impression that a stock's down. But you do it anyway because the S.E.C doesn't understand it. So that's the only sense that I would say this is illegal. But a hedge fund that's not up a lot really has to do a lot now to save itself. So this is actually just blatantly illegal. But when you have 6 days and your company may be in doubt because you're down, I think it's really important to foment. If I were one of these guys, this is actually just blatantly illegal. But I think it's really important to foment. If I were one.
Analysts. Have you ever wondered why stock analysts, the people who predict whether you should buy, hold, or sell a stock, never have a hit percentage next to them? Like a percentage on how accurate their predictions have been in the past? Kinda like how baseball players have their stats? It's because they would be out of a job because they're usually wrong. And yet, they still hold a ton of influence over the market, don't ask me why. Especially in smaller stocks. People still take them seriously, which makes analysts a great tool for our manipulation. Since analysts work for hedge funds, investment banks, etc., they can't bite the hand that feeds them. So if you want to buy a stock or you're shorting a stock, you can theoretically have analysts downgrade that stock. If you want to sell a stock at a higher price, you can have analysts theoretically upgrade that stock.
A lot of analysts work for investment banks or banking sectors of some kind, or are supported indirectly by investment banks, right? Analysts are supposed to be independent most of the time. But give me a break. These analysts are getting the checks cut by the investment banks. So do you think the investment banks are really going to go against what their shareholders and what their investments are in?
Journalists. Journalists are arguably even more powerful than analysts. Because if a journalist publishes a news story about a stock, people outside of Wall Street are influenced as well. And journalists are also very easy to manipulate if you want a stock to go down. Journalists have an incentive to publish bad news, because bad news gets more clicks equals more money for the publication, more money for their employer equals better career prospects for them. This is coming from personal experience as a YouTuber, kinda like what we're doing in this video.
And this is very easy because the people who write about Apple want that story. And you can claim that it's credible because you spoke to someone at Apple, because Apple isn't and it doesn't.
Right, they're not going to comment.
You can leak a juicy story to a journalist directly.
Then you would call the journal and you get the bozo reporter.
Or you can spread it to others on Wall Street, knowing that it will eventually make its way to a journalist.
And the way you would do that is you pick up the phone and you call 6 trading desks and you say, listen, I just got off the phone with my contact. There's no room for Apple. They want too much. We're not going to let them in. We're not going to let them do what they did to music. And, I think that's a very effective way to keep a stock down.
Right.
Anonymous articles. Let's say you're even lazier than that. You don't want to deal with journalists, or you want to avoid any potential lawsuits or damage to your reputation. An even easier route you can take is to post anonymous hit pieces about companies on influential websites like Seeking Alpha. Now this may sound kinda silly, like who in their right mind would base their investments on anonymous articles on the internet? But the results speak for themselves. December 2015, anonymous short seller Investor for Truth pushes United Development Funding 4 down 35%. After much speculation, Kyle Bass of Heyman Capital Management reveals that Investor for Truth is him. Ironically, Kyle Bass has been featured on this channel. Bank of California. An anonymous article by short seller Aurelius caused the stock to plummet by 29%, the CEO and vice chairman stepping down, and the S.E.C initiating an investigation, all from one anonymous article. Bank of the Internet has been the subject of around 30 short seller pieces over 3.5 years, bringing it down as far as 37%. EROS International. Short attacks pushed the Indian Bollywood filmmaker down 50%. Acoustics Technologies. Short attacks pushed it down 43% at one point. Why does this work? Because you don't need to convince a lot of people. All you need to do is to instill a little bit of doubt in some, they will sell, maybe some journalists will pick up the story giving it credibility, which will cause other people to sell, which will trigger a domino effect of herd selling. And next thing you know, a stock is down 50% thanks to a few anonymous articles, making you at least a 50% return. And maybe if you borrow some money to trade with, i.e. trading on margin, you can make upwards of 100% on just one short attack. And the best part about all these strategies, it's that it's hard to prove, and the S.E.C are too incompetent to prove it.
The way that the market really works is to have that nexus of hit the brokerage houses with a series of orders that can push it down, then leak it to the press, and then get it on CNBC. That's also very important. And then you have a kind of a vicious cycle down.
Right.
And it's a pretty good game. These are all the things you must do on a day like today. And if you're not doing it, maybe you shouldn't be in the game. Okay.
So, Tran Capital, our venture capital firm, will now be opening up its own hedge fund division, and we will be employing all the tactics we went over in this video so that you know your money is getting put to good productive use. If you are new here and you want more dark sarcasm and only the best video essays on the most provocative, thought-provoking stuff in the world of business, just like this one, there is a red button below that says subscribe that you can click for more free videos just like this every single week. And the best part is that you can dislike, unsubscribe, leaving your best hate comments whenever you want, so you have nothing to lose and everything to gain. And you can also turn on that notification bell to get notified when new videos come out. If you want business memes, behind the scenes stuff, day in the life kind of stuff, you can follow me on Instagram at jtrend.io, where we have a ton of fun over there. That is going to wrap it up for this video. Thank you so much for watching. Stay dangerous out there, and I will see you guys in the next one.